Hey, just wanted to say thank you for joining us. We're seeing some people log in now. And so we're just going to take a couple more minutes. Sorry, we've had a couple of technical difficulties, but we're working through those. So we'll get going here in just 1 second. But just wanted to say thanks.
Steve, I'm seeing a lot of familiar names on our attendee list. So grateful to have everybody. I'm excited to share this with everyone because these are what you wanted to know about. So this is definitely a good one for sure.
Yeah, thank you guys so much. This format is going to be a little bit different than our ones in the past. We kind of wanted to gear this towards you and your questions that you're having right now. Obviously, there's some pretty unprecedented activity going on in the market, and thought it would be a good opportunity to answer the questions that you found most pressing. So we have Aaron Martin and myself from the LAD group. We'll be kind of handling a lot of the real estate related questions. And then we've got Giancarlo Gatto with Northwestern Home Loans. He's on as well, and he will be helping us through some of the lending questions and interest rates and some of the things that we're seeing with that. So for the sake of time, it sounds like we do have a number of people on. So I think we should just get going. So first, again, just wanted to say thank you. We asked for about the last week or so, we asked for some of the questions that you found most pressing that you really wanted to get answers for, and tried to boil those down to about 5 questions. And so the 5 questions that you see on the screen are the questions that we're going to be handling. And so we'll just jump right in. So the first question was, how long will these prices keep rising and remain in this multiple offer frenzy? And you're not going to like this, but I'm going to say I don't totally know. What I do know is that a lot of people are still expecting home prices to continue to rise this year. You look across the board, this panel of 7 different experts have all kind of predicted that on average, they're expecting about 6% home appreciation. If you compare that to what we saw this last year, it's a little bit lower. So across the nation, on average, it was, depending on what region you were in, it was about 11% appreciation. And then locally, we were looking at a higher number. So we were looking at about 25% appreciation in Bend, as well as probably about a 19% appreciation in Red Bend. And so, I think it's important to kind of talk through what leads to that appreciation. And in general, the housing market, I know Brian has said this before on previous webinars, in general, the housing market is a really good example of supply and demand at work. And so one of the things that we've certainly seen, and you've heard it on our newsletters and our webinars, is that over the last 12 months, we've seen extremely high demand, and there's been virtually a complete lack of homes for sale. And so this next chart really shows that point. So normally, there's a little bit of seasonality with regard to new listings coming on the market. We generally see the lowest amount of inventory coming on in December, with them gradually rising to about a peak in June. And so, one of the things that we saw this last year was that if you look at those December numbers, it was actually about 80% higher this year in terms of number of new homes coming to the market compared to what we saw 1 year ago. So that's a good sign. We're seeing more things come on. January and February were right in line with last year. And we are expecting that over the next few months, both this seasonality that we generally always see, as well as some other factors like people who've been looking to get their house sold or to thinking about selling their house, are finally coming to it. They want to realize some of the equity gains that they have in their homes. And so they're really starting to explore and get those houses on the market. And with that should certainly come some relief with regard to prices. More homes to choose from generally means that we won't have quite that push where everybody's fighting for the same house. So certainly there are some other components in here, and demand's certainly a piece to it. At least one of the parts of demand would kind of stem around interest rates and lending. And so since our next question is actually about lending, I'm going to turn it over to Giancarlo and have him take the next question.
Sure, thanks, Steve. So the next question is, how should a buyer getting a loan prepare themselves to compete in this market? So the answer to the question, I think, is within the question. So essentially, we want to prepare. You're going to be faced with a lot of things being thrown at you when you're making offers, multiple offer situations, contingency waivers. And really, from a financing perspective, we want to talk about how that impacts your bottom line in terms of cash out of pocket, monthly payment, on top of all the craziness in the housing market. Mortgage rates are fluctuating as well now too. So we've seen a little bit of a rise in the last, couple months. It's nothing crazy. Contextually, you can see on this graph, as of January 2020, we were in the high threes, and that was, considered great. So now we're back at around that low 3% mark in most scenarios. So, it's a good time to check back in with your lender and see exactly where rates are. You may have talked to them 3 or 4 months ago and rates were 2.75. And this is going to have a little bit of an impact on your payment. So Steve and I ran some rough numbers earlier. On a $400,000 mortgage, just as a baseline, it looks like every 0.25% on an interest rate is about $55 per month is what it translates to you. So, you can see how the interest rate fluctuation and keeping that communication with your lender comes key. The other thing that we see a ton, in the midst of a crazy buying frenzy and multiple offers, you don't want to be figuring out your finances at that moment in time. So, before you go and fall in love with a house, you definitely want to make sure you get a solid pre-approval. Your income and assets have been documented and verified. Your credit has been run. You've talked about potential scenarios, even if it's just a property that's sold recently that looks similar to something you'd like, at least to plug that in as a placeholder to see if you're eligible, what the payment looks like, what the taxes and insurance are like in the market, when it was built will depend, a lot of it will depend on that as well with taxes. So, that preparation and that level of confidence in your financing is going to help you a lot to focus on what you're really trying to focus on when you've got multiple offers and things like that are thrown out. We're seeing appraisal contingency waivers. We're seeing earnest money going hard immediately, all that kind of stuff. If you're unsure of your financing situation, that can add several layers of stress to it. So, and you want to be prepared for that bidding war. It may take you into a jumbo loan, whereas you were in a conforming loan to begin with. So definitely preparation is key with all that.
And Giancarlo, we're certainly kind of educating our buyers that when they're looking at homes to be a little bit under the threshold of, either it's, going into a jumbo loan or even in terms of what their buying power is, simply to kind of take into account the fact that it's very likely it will need to go up and over asking given the multiples that we're in. I have a quick question for you. We're hearing this so much and I just love your insight on it. Do you, we've heard speculation that we can expect fairly low interest rates all the way through 2022. What do you think of the recent creep? Do you expect kind of for the long term that would remain and it'll continue to creep? Or are you thinking that, we'll see more drastic chunks, in the future?
Yeah, it's hard to say. And obviously I get this question a lot as well. We did a presentation towards the end of the year and most of the metrics look pretty similar. Most economists from Association of Realtors to Mortgage Bankers Association predicted 3 to 3.5% as kind of the range for 2021. It seems like that's probably looking pretty accurate. As most things are right now, it seems like it's kind of COVID related. And so as the COVID numbers goes, the faith in the economy or lack of faith in the economy, inflation, all those things kind of get factored in. But I think, it's been a steady creep upward. It kind of shot up for a 2-3 week period there. And it's kind of stabilized, maybe creeping up slightly in the last week or so. But I think an assumption of some kind of inflation is into the market, an assumption of some kind of COVID resolution is kind of baked into the market. So, if we see things change drastically from those expectations, maybe we'll see jumps in rate. But, it seems like that low to mid 3% range is probably where we'll be, save for something, crazy happening in the global economy or, American economy.
Yeah, that's always the tricky part, right? It's trying to assess the numbers. It's hard to make the predictions on where it eventually will be, but really what you want is to be able to take a look at it, see what's out there, see what's available for, any of our various clients, and then allow them to make, the best decision. I mean, one of the chart that we have up now, I think helps hammer home, even with all of these rate discussions and things going up and down, prices going up, homes are still, overall, they're more affordable today than they have been for a number of years. I mean, looking at this chart, it goes back to 1985, even with the prices where they're at and interest rate, the fact that interest rates are where they are, even at the now elevated levels, homes are still overall incredibly affordable. So
yeah, it'll be interesting going forward to see how the impact of interest rates. But overall, again, on that theme of communication, I always tell my clients, before you put in that offer, let's just touch base. Let's talk about what the property taxes are. Let's see where interest rates are. Let's talk about, okay, what does a $400,000 offer look like? And then just mentally prepare yourself. What does it mean to go up to 450 or 475? Because I mean, we're seeing that kind of stuff on the regular. And to wrap your head around that from a monthly payment and cash out of pocket standpoint and feel confident there, those are the numbers that are most relevant. 400 to 475, those are huge numbers that really is hard to contextualize for people. I think the relevant numbers are, what does it cost me per month and how much do I have to put out of my pocket to get there? And so to contextualize those before getting into that multiple offer situation just kind of takes one layer of unknown, out of the mix.
Awesome. All right. Well, Aaron, it looks like your question is next up, and it's also about preparing.
Oh, certainly. Well, I just wanted to kind of tap into what Steve had mentioned earlier, which is that we are seeing a little more supply come on the market. So 436 homes in the last week here in MLS for Central Oregon in general, which is, certainly year over year is not applicable for this last year because we know that things were pretty shut down, 1 year ago, but is, I would say a little low, but on par with what we've seen in previous weeks, in this March kind of pre-spring break timeframe, certainly. So that's a really positive thing that we are seeing more inventory come on. People are making the shift to kind of be ready as we get into this spring timeframe when people would normally list anyways. And I think what they're trying to do at this point, what we're seeing in terms of the shadow inventory, what we call it, which is just the resale homes versus the new construction homes, we're seeing kind of movement toward listing. And then that's going to create some relief for everybody on the buyer side, certainly. So I think that that's really positive. So with that, one of the big questions that we always get is with regard to contingencies. And if you think about contingencies as kind of like a little bit of a domino effect, typically somebody who wants to buy a new home has to sell the home that they're in. And oftentimes they get an offer from someone who has to sell the home that they're in, and it can go many layers deep. We've done many deals that way, and we kind of, bite our nails all the way to the end because there's just so many things that could, come into play at that point. But what we're seeing, we're getting questions from sellers specifically about contingencies on the seller side. So, hey, should I list my house and make it contingent on finding a replacement property? And then we see it also on the buyer side where people say, hey, I want to buy this house. I need to make a contingent on buying or selling my current home because I need to take the liquid funds from the equity, take the equity from the house that I'm in and put that into the next one. And so when we're talking about contingencies, I just kind of want to make sure that we're all on the same page with language. You'll hear it referred to as active with contingency, contingent bumpable, contingent right to sell. Oftentimes we'll put in predicated on the sale and closing. But when you hear that word, you can kind of replace it, with the word protection. So by making an offer contingent on the sale of your house, you're protecting your earnest money by saying that that if you can't sell your house, no harm, no foul, you just walk away and you get your earnest money back. That's basically what it means. And so you can imagine on the seller side that that's pretty risky for a seller to take that. And with the multiple offers that we're seeing, it's very unlikely that you'd get an offer through contingent on the sale of your house. Same thing with the reverse side. So if you are, a seller and you want to make your sale contingent on the purchase, finding a replacement property, which so many sellers are wanting to do right now. They say, hey, we recognize it. This house is it's too small. There's a pinch point, in a certain part of the house, whatever it might be, not a big enough yard, but we don't know where to go, which we hear a lot. And so the sellers say, hey, maybe we can make it contingent on finding the next house. And that's certainly very risky for a buyer too. And that narrows your buyer pool substantially, because those buyers want to know if they're going to go ahead and move forward with their loan, if they're going to, get moving on things, they want to know that that the house is a sure thing. So there's a couple things that we would suggest. So one thing that we're telling our sellers right now is, hey, let's get your house on the market, get it sold. And because we're in this kind of, seller market, let's just ask for a really long rent back. With lending, there is kind of a limitation for how long you can rent back before it becomes, a rental lease. So we'll talk about that when we're supporting you. But let's just ask for enough time that you can then go shopping with the proceeds of the sale of your house, and therefore make offers not contingent, be more competitive in this marketplace, and really kind of benefit from that. Another way we would another thing we would suggest, a way around it, if you will, is to kind of look into different lending products. And I'll let Giancarlo kind of chime in here, but perhaps there's a way, similar to the old bridge loans, or perhaps there's a way that you can make an offer on a house and purchase that one without actually making it contingent on the sale. A couple of ways that we would not suggest doing it, which we've had clients ask us, and we would advise against it just because of the risk factors involved. So we've had people say, hey, why don't I just take the down payment out of my 401k and then, buy a house with it, and then sell mine after I've moved into the new one, and then replenish my 401k afterwards. And of course, I'll let Giancarlo speak to this a little more as well, but we think that that's too risky. We think that you don't need to do that. There's other ways to do it. And when you're talking about contingencies, make sure you're sitting down with a professional and kind of really digging into what that means. The other, way that we've seen people do it in the past is, hey, we're in this hot sellers market. I want to be competitive when I make an offer on the new house. I just know mine's going to sell, and so I'm just going to risk my earnest money. So you don't make it contingent on the sale, and you just put yours up for sale and trust that it will. I would say that it depends on the amount of earnest money, and it depends on your appetite for risk. I think it's something that absolutely can happen. We don't always recommend it, only in specific circumstances. But those are some things that we're seeing in the marketplace with regard to contingencies, and hopefully that kind of answers the questions that have been put forth by all of you. Giancarlo, do you want to add anything to that?
Yeah. Thanks for looping me in, because it's something I forgot to mention. If you've got equity in your current home, again, this speaks to have these conversations early. There's some ways to structure this where you can make a non-contingent offer, where it's not quite as risky. I'm a big advocate for home equity lines of credit. But once you've put your home up for sale, it's difficult, if not impossible, to get that home equity line of credit. But prior to listing it for sale, you can usually put one of those in place for little to no cost, use that for your down payment funds. And then when the house sells, that obviously gets paid off, and you can use additional equity to pay down the balance of your mortgage, or do a combo loan, or there's lots of options there. So if you've got the equity in your existing home, have this conversation with your lender early to come up with a strategy to come up with a non-contingent offer, because a lot of times it's too late. A bridge loan, they're tougher to do, and you're still going through a financing process to get that bridge loan while you're under contract. So it's a lot less stressful to put that line of credit in place prior to going under contract. You've got access to the funds, make your down payment, and then list your house and sell it afterwards comfortably without having to feel rushed to accept an offer because you need the cash to make the purchase. So there are definitely options, and the sooner you assess those options, the more there are. So yeah.
Yeah, it's great. The general takeaway is be prepared, have worked through all your options. It's obviously a fast market. So when the time comes to either buy or now you want to sell, it's a little late to start doing all of your research on what the best scenario is. That should have been happening. And so all good stuff. All right.
It's the least fun thing to talk about, but you know.
Right. All right. So the last two questions, actually, not surprisingly, revolve around what we saw last time and how this is different. And so the first of the two questions, this one is kind of geared towards foreclosures, and are we expecting there to be a run of foreclosures over the next year? And then the other one is just kind of back to the same question of, is this a bubble? And so with regard to foreclosures, you know, oh, and by the way, I did want to say we will share these slides after the fact, so you can have all of these. I'm not going to touch on all of the points here, but obviously most people are aware that the administration has been trying to do what they can to help protect homeowners. Obviously, there are a lot of people that are really struggling. And so they've tried to protect both renters and owners from making those payments and not losing their houses. So, you know, a few things have been extended with regard to this. I just clicked over to the next slide. So what does that mean? What are we expecting in terms of the number of foreclosures that could potentially be coming to market this year? And so this Altos research group has done a survey, and their prediction is that about 325,000 potential foreclosures can hit the books this year. I know that number sounds like a lot, and I think it is an important chart to look at, that those added foreclosures, although it's never something that you really want hitting the market, it does, again, provide some more of that much needed supply that we've been talking about. And so with the potential foreclosures that they see happening, in addition to the inventory that we're seeing right now, it does put us back in a range of generally what we've seen in years past. And so to put the 325 number in perspective, we can look back on what the number of foreclosures were in each of the last years. And this chart goes back 15 years. Obviously, 2020 is artificially low, given that they put a moratorium on them starting last March. So that number is low, but every year prior had higher numbers than what we're at least expecting to see this year. So, you know, I guess that kind of does beg the question of, with so many people in forbearance who have potentially delayed their loan payments and could be getting a little bit further behind, how is that possible that we're only going to see 325,000 foreclosures? And I think this chart, we may have shared similar charts in the past. This chart represents people that have gone into forbearance. So people that have been delayed in their payments and have some type of potential strategy to get out of it. And when you look at this chart, you see over 50% have already brought their payments back to current and are out of forbearance. You know, another 33%, 34% have created some type of payment plan. And so really the risk falls with that group, that, you know, additional 15% who haven't made any plans, they're behind in their payments. And these are going to be the ones that are going to be coming on market. Those will be what make up that 325,000. And not to flip slides back, but there was a slide that we had on there when Giancarlo was talking about that 15%, the people that are behind and potentially going to head down the path of foreclosure. Not everybody will. We're in a very different situation than we were in 2008, when everybody was highly leveraged and the houses were worth less than what people had, than equity that people had in those homes. And so right now, there are about 85% of homeowners have at least 10% equity in their house. That's a pretty staggering number. So what that means is those people are going to be able to, a lot of those people are going to be able to put their house on the market and sell it a more traditional way, as opposed to having to lose it to the bank and having the bank have it put on the market at low levels and flood the market with inventory. So I do think it's worth noting, and that does lead us into the next question of, you know, are we in another bubble like we were in 2008? And, you know, there were a whole bunch of reasons why we ended up in the situation that we did. Giancarlo was doing loans back then. There was very easy access to money for buyers. People were, the term irrational exuberance was used over and over again. People were getting into homes that they probably wouldn't have qualified for, they shouldn't have qualified for, just to try to turn a profit, just to have some gains and just be involved. And one thing that I will say on that is the demand is really different right now. So, people are buying homes, and the reason we've seen this influx of demand over the last year is because people are buying homes based on needs, not necessarily for a quick financial gain. They're buying it because, they're working from home now. They have more people in their house now. They want to, this last year has kind of showed them that time is valuable, and it's fragile, and they want to be in the place that they've always dreamed about being. And so, that is certainly one of the primary reasons we've seen Bend be as attractive as it is. And another piece to that demand portion is demographics. And so, what we're seeing now is millennials, ages 25 to 40, are stepping up in droves to either get that step up house for the older millennials who had already gotten into something, but a lot of them had been delayed, and now they're making that move for the first time and getting into a home, and they're getting into a home for the long term. And so this is the largest generation right now, and we're seeing more millennials step into the real estate market for the first time than we've ever seen before. And so I think it's worth pointing out the difference in demand. It's not being driven just for financial gains. It's squarely around people's lives and their lifestyles. And I think that's an important piece. And so,
and Steve, when you say that, Central Oregon as a microcosm is appealing to that particular demographic, and also they're more likely to have a tech job, which means they can do it really remotely from anywhere, and therefore there's kind of a lot of movement into Bend from that specifically, you think?
Yeah, absolutely. I mean, that's a piece to it. And honestly, we'll talk at the end. There are different ways to interpret a lot of this information, right? I mean, people are working from home now, but will that last forever? At what point will companies start calling them back? And to what extent? Is it going to be a day or two? Is it going to be, back to in office full time? How that plays into it. I mean, we could talk the same thing about interest rates. If interest rates tick back up, does that lead to a rush of people trying to get in before they get too high? Or does it cause people to sit on the sidelines for a little bit? And so, again, I know we just want the clear-cut answers, but this is why it's important to kind of go through all the different scenarios and how they can play out. So I think it's worth noting that not everything is just rosy, and there are different ways to interpret this. And but going back to the slide here, even if some of those things happen, so interest rates go up and demand pulls back, or people get priced out a little bit and demand pulls back because of that. The difference between now and 15 years ago was that we had so much inventory. So when that demand dropped, we had so many homes on the market. And so looking at this chart, at the height, there were 2,500 homes on the market. And so when demand dried up, now there were so many homes, and there weren't anywhere close to enough people to do it. And that's where we really ran into some challenges. When you look at this year, as of today, we're at about 100 homes available in the city of Bend. And so there is some room in there to absorb. I mean, it's that oversupply combined with the lack of demand that was one of the biggest contributing factors in the mid 2000s. And that scenario really just isn't applicable today. And so, yeah, this is just another example. This is nationwide. Our numbers in Bend are actually even smaller than this. Depending on what price category and what size home you're looking for, there are homes that are, or the number of homes can be measured in weeks as opposed to months. This says if no new houses came on the market, based on the pace that homes sell, how long would it take to work through it? And in certain price points and in certain categories, it really is a matter of weeks. And so that's what's leading to that crazy demand. And so again, supply is kind of at the crux of it. This last chart with regard to this is talking about single family housing. So new construction we're at still record lows as compared to where we were in the mid 2000s. It has been increasing. Builders have been trying to get things in the ground. Obviously, we've talked about it in past webinars. There's urban growth boundary and city of Bend city limits and development standards that we have here that, you know, don't allow that sprawl that a lot of neighborhoods or a lot of cities and states have. But you know, builders are trying to get some stuff in the ground to try to help equalize those levels, and that also should help. So I know that's a lot.
One thing I would say, Steve,
yeah.
that we're noticing is that even when the builders are releasing inventory that we're expecting, so Northeast Bend, a big, you know, development called Petrosa, which is 400 homes, Southeast Bend, another one similar, West Bend in the Shevlin area, even when the builders are releasing them, they're releasing 5, 6, 7, 10 homes at a time, whereas it used to be that you could choose them, you could go to a builder and you choose among 40 lots and you choose your floor plan and that's where it goes. So even then, you know, the scarcity is still at play. And so if we're thinking that new construction is going to be the thing that floods the market with a bunch of additional inventory, it just neither does the land exist and nor do the builders want to build speculatively that way. So
yeah, it's a good point.
That.
Yep, absolutely. So some closing thoughts. So yeah, for the first one, predictions are tough. Obviously, there's a lot of data here. You know, we pore over this stuff constantly. We believe that it's our job to share it with you and then try to help you make an informed decision. I mean, that's what it comes down to. For some people, the best thing to do is to do nothing. For others, it's to make a move, whether it's to buy or to sell. But we want to go through all of the data, help you make that decision, and not stand here and say, I know where this is going. This is what we're going to see in the next 3 months, 6 months. We all want to kind of arrive at that conclusion together. And so be steady and be ready. I think we kind of hammered that point home between Giancarlo and Aaron about being prepared, doing your homework, being ready to go. You know, one of the things that I'll say is our team was a part of 225 sales last year. And what that means to you is more than likely we've seen that scenario play out, right? We're not prone to getting surprised by things. And so we want to be here and be able to share that expertise and see how that can affect you and your plans. Because we take this seriously. This isn't just another deal. This is your home. This is your well-being. This is your life. So stay informed. We are constantly poring over the data. We've got a new state of the market that we put out twice a year. That's coming out. That's going out to the printers and will be in your mailboxes and online in the coming weeks. Giancarlo's got a piece in there about interest rates and mortgages and how all that plays into it. So definitely, if you're not on our mailing list, we'd love to have you on our mailing list. Follow us on Facebook, send us an email, get a hold of us. And then lastly, I just wanted to say one more time that we're here for you. It's challenging times, to say the least. We understand that everyone's situation is different, but we really do want to sit down and talk to you and hear from you and hear what your needs are, and then try to propose a solution that you know best allows you to fulfill your goals. So with that, unless anybody else has something to say, I'll just say it once again. Thank you. We appreciate you. We appreciate you taking the time to listen today, to get on this webinar and spend, 35 minutes of your time. So we look forward to hearing from you, and we wish you all well. Be healthy, be safe.
Thanks, guys.
Thanks.